In the world of finance, cash is king. And that's why working capital management is so important. Working capital isn't just about keeping the lights on. It's about having the flexibility to seize opportunities and weather financial storms. Imagine running $1 billion business, but you can't pay your employees next month. Sounds impossible? It happens all the time when companies mismanage working capital. Now, the formula for working capital is simple. Current assets minus current liabilities. Essentially, it's a company's ability to cover short-term obligations and keep its operations running smoothly. If working capital is too little, there's a risk of insolvency, going bankrupt. If it's too much, that means you've got capital tied up, not generating returns. Let's take an example of Walmart. Has mastered working capital management. Firstly, Walmart turns over inventory faster than competitors, keeping cash moving. Even then, as a retailer, of course, it's got a lot of inventory on its stores and shelves and warehouses, billions of dollars of inventory. However, on Walmart's current liabilities, you would see a near matching amount of accounts payable. Walmart squeezes its suppliers for extended payment terms.
This is Walmart. They're big, they're tough. They've been long known for squeezing every last penny out of suppliers.
Walmart uses credit from suppliers to finance the inventory instead of using its own capital. The result? Billions in free cash flow despite razor-thin profit margins. Let's take another example of Boeing. Which struggled with supply chain delays leading to excess inventory buildup and negative cash flow.
Boeing is a perfect example. They had north of $25 a share of free cash flow as little as a year ago. And now they're probably somewhere 3 times leveraged at this point. And this is the outlook, and this is the downgrade, and this is one of the biggest, most important companies in the world.
Now, the working capital crisis forced Boeing to raise debt just to stay operational.
CNBC reports that according to sources close to Boeing, the company has secured around $6 billion from Wells Fargo and Bank of America Merrill Lynch, among others. But that number could jump as Boeing's losses increase and as banks make more demands.
Boeing has announced plans to raise up to $25 billion through stock and debt offerings. Now, this alongside a $10 billion credit agreement with major lenders like Bank of America, Citibank, Goldman Sachs, and JP Morgan.
So the lesson here is that working capital is about timing cash flows, not just profitability. Now let's talk about Ford Motors versus Tesla. Now, Ford builds cars before customers buy them, which means they've got inventory sitting for weeks or months before being sold. The longer Ford holds inventory, the more capital is tied up, increasing financing costs. On the other hand, Tesla has prepaid orders and down payments. So Tesla has flipped the script. Customers place deposits on cars months before they manufacture. This injects cash into the business before production begins, minimizing working capital needs. Tesla also sells regulatory credits for cash, further optimizing its working capital strategy. Mastering working capital is mastering financial agility, because in business, survival isn't about how much money you make, but how well you manage cash.